Today, we're talking about a firewall, but it's not for your computer. Nope. This one is designed to protect our entire financial system. It's a story about how one critical rule, powered by some seriously massive databases, is supposed to stop a total meltdown. All right, let's jump right in. Everything starts with a nightmare scenario. I mean, just imagine a full month of absolute nonstop panic in the financial markets. It's the kind of situation no bank ever wants to face, but it's one they all have to be ready for. So that brings us to the big question, right? Can a bank actually survive 30 days of pure, unadulterated stress? What happens if the markets just completely freeze? What if every single customer, all at once, decides they want their money back, right now? It sounds like something out of a movie, but this is the exact scenario that keeps regulators up at night. 30 days, that's the magic number. It's seen as this critical window where a financial panic could just, spiral completely out of control and take down not just one bank, but maybe the whole system. So the regulators came up with a test, a kind of simulation of this nightmare month, to find out which banks are truly built to last. Okay, so to pass that test, banks need a shield. Not a physical one, obviously, but a financial one. And it's built from a very specific and pretty powerful formula. This is the defense mechanism that's designed to let them weather that 30-day storm. And that shield has a name, the Liquidity Coverage Ratio, or LCR for short. This is the official answer to our big question. It's basically a rule that says a bank must, at all times, have enough easily sellable, high-quality stuff to cover all the cash it would probably lose during that 30-day panic. The easiest way to think about the LCR is like a balancing act, or a tug of war. On one side, you have your high-quality liquid assets. That's all your good stuff, your financial shield. And on the other side, you have your net cash outflows. That's all the money that's rushing for the exits during a panic. And here is the bottom line, the one rule to rule them all. The value of your assets has to be greater than or equal to your expected outflows. A ratio of 100% means for every dollar you expect to fly out the door, you have exactly $1 in your emergency stash. Anything less, and you fail the stress test. Simple as that. But okay, this is where things start to get a little tricky. What exactly counts as a high-quality liquid asset? I mean, in a panic, you can't just sell your office buildings, right? You need things you can turn into cash almost instantly, and without losing a ton of value. So as you can see here, not all assets are created equal in the eyes of regulators. They have this strict hierarchy. Level 1, that's the absolute gold standard. Cash, government treasuries. But as you go down to level 2 assets, regulators get more cautious. They apply what's called a haircut, which basically reduces its value for this calculation. Think of it this way. A stock might be worth $100 today, but in a full-blown panic, you might be lucky to get 50 for it. Regulators build that potential loss right into the math from the get-go. Now let's flip to the other side of the scale, all the cash flying out the door. The bank has to model every possible demand for its cash. And we're not just talking about you and me taking money from an ATM. We are talking about much bigger things. Companies demanding loan repayments, huge corporations drawing down their entire credit lines all at once. The bank's model has to simulate all of this chaos happening at the same time. Now, this whole thing might sound a little academic, but it's not. This entire framework, this whole elaborate stress test, was born from the ashes of a very, very real crisis. It's a direct lesson learned from the financial collapse of 2008. And this timeline really tells the whole story. In 2008, we all saw that even gigantic banks could just vanish overnight because they ran out of ready cash. So in response, regulators from all over the world got together and created the Basel III Accords, a whole new rulebook for banking. And what was the centerpiece of those rules? You guessed it, the Liquidity Coverage Ratio. It's now the global standard. Which brings us right back to where we started. We've talked about the financial formula, the history, but now we need to talk about the machine that makes it all possible. This is where that idea of a firewall gets very, very real. I love this quote from our source material. The LCR isn't just a number, it's a firewall. It drives home the point that it's not just some accounting metric you check off a list. It's meant to be an active protective barrier. But what is that barrier actually built from? The answer is data.
Behind that simple ratio is a database of just mind-bending complexity. I want you to try and imagine a system that has to track every single asset a bank owns, categorize it perfectly, apply the right haircut in real time, and at the same time, model every single dollar that could possibly fly out the door. It is a monumental data challenge. This isn't just a finance story anymore, is it? It's a massive, massive database story.
And the demand on this database is absolutely relentless. This isn't a once-a-year thing. Regulators require daily tracking of the LCR. Banks have to submit formal, detailed reports every single month, and their own internal systems have to have real-time alerts that scream if they even get close to dipping below that critical 100% line. It is a constant 24/7 data crunching operation. So the 30-day firewall, this incredible database system, it's all designed to make sure a bank can survive a panic. Next month. But that leaves us with one final, pretty important question. If the LCR is all about surviving the immediate future, what about the long term? What rules and what systems are in place to make sure a bank is stable not just for the next 30 days, but for the next 30 times years? Well, that's a story for another time.